Welcome to the deep dive. We take the source material you're curious about and, well, we extract the knowledge you need fast.
Get right to the core.
Exactly. And you've sent us a really fascinating set this time, all centered around large language models, LLMs, and how they're shaking things up in finance.
Big topic right now.
Huge. We've got this detailed research paper, financial statement analysis with large language models. Then there's a major report from the Bank for International Settlements on regulating AI in finance. Lots of focus on recent developments and the main challenges.
Yeah, the regulatory angle is crucial.
And finally, a shorter piece, just to give us another perspective.
Yeah.
Sentiment trading with large language models.
Adds another layer.
Right. So our mission today is really to get a handle on what these LLMs can actually do with financial data and also grapple with the big questions that pop up as they get used more and more.
Potential versus pitfalls, basically.
You got it. Okay, so let's dive into that first research paper on financial statement analysis.
Sounds good. So the core question in that one is pretty straightforward, really. Can an LLM, they use GPT-4 analyze financial statements like a human analyst? Maybe even better.
Okay, how did they test that?
Well, they gave GPT-4 these standardized financial statements. But here's the key part. They stripped out all the identifiers. No company names, no specific years, no narrative text.
Just the raw numbers, essentially.
Pretty much. Standardized balance sheets, income statements. And the task was predict if the company's future earnings will go up or down, just based on that numerical data.
And this is where it gets really interesting, right? Because the results were, well, kind of startling.
They were. The big finding was that GPT-4, even without all that extra context, is human analyst relies on like industry news, management discussion.
Yes, all the qualitative stuff.
Exactly. Even without that, GPT-4 actually did a better job predicting the direction of earnings changes than the financial analysts in their comparison group.
Wow, better. That's significant. Forecasting earnings is bread and butter for analysts.
It really is. So it suggests these models might be picking up on patterns or relationships in the pure financial data that maybe even experienced humans are missing, or perhaps weighting differently.
It really makes you rethink what financial insight even means, doesn't it?
It does. And another fascinating bit, its accuracy wasn't just better than the humans in this setup. It was also roughly on par with a specialized machine learning model that was specifically built for this kind of earnings prediction task.
Okay, so it's not just beating humans, it's competing with dedicated quantitative models too.
That's what the results suggest. It hints that these general-purpose LLMs might have more quantitative reasoning ability than we perhaps initially gave them credit for.
Okay, but the immediate question that jumps out is, was it just memorizing? I mean, these models see so much text data. Did it just recognize patterns from its training?
That's a really critical point, and they did look into it. They ran specific tests to see if the LLM was just recalling info. The evidence points away from memorization. For instance, they prompted it to guess the company names or the specific fiscal years based on the anonymized statements it analyzed.
And it couldn't do it.
Nope. Accuracy was very low, which strongly suggests it was actually analyzing the financial relationships in the data presented, not just retrieving something it had seen before.
Okay, so if it wasn't memory, how is it doing it? What was the mechanism behind its performance?
The paper argues that the LLM was generating useful narrative insights about future performance.
Wait, narrative insights from just numbers? How?
It seems it could identify trends, calculate or infer ratios, and then synthesize these numerical observations into sort of coherent rationales for its predictions, like telling a story based on the financial data.
That's quite something. Taking abstract numbers and creating a plausible explanation for what might happen next. Did they look at the economic impact? Like, could you make money off this?
They did. They simulated trading strategies going along on companies GPT predicted would have earnings increases, shorting those predicted to decrease.
And the result?
Pretty compelling. These GPT-based strategies showed significantly better risk-adjusted returns, higher Sharpe ratios, and generated positive alpha, even after accounting for standard market factors.
So, real potential economic value there, not just theoretical accuracy.
Potentially, yes, according to their simulations.
It really flies in the face of the early assumptions about LLMs, doesn't it? The idea they were good with words, but maybe clumsy with numbers or complex math.
Exactly. This study provides pretty strong evidence that they might be more versatile, more capable in quantitative domains like finance than maybe we thought.
The paper talks about prompt engineering, too, using something called chain of thought prompts. Can you break that down?
Yeah, so prompt engineering is just about how you ask the question, how you frame the task for the LM. They trade simple prompts, like predict earnings, up or down.
Okay.
But they also use these chain of thought, or COTI prompts. These are more involved. They essentially guide the LLM to think step by step, mimicking how a human analyst might work.
Like first look at trends, then calculate ratios, then explain your reasoning.
Precisely. Analyze trends, analyze key ratios, then provide a final prediction and the rationale behind it. It forces a more structured reasoning process.
And did that make a difference, the chain of thought approach?
A big difference. The study found GPT-4's performance was significantly better using the COTI prompts compared to the simple prompts. That structured reasoning led to more accurate predictions.
Interesting. It's like showing your work helps the AI, too.
Sort of, yeah. It channels its capabilities more effectively for this specific task.
You mentioned they anonymized the data carefully. How exactly did they do that? Just removing names?
It was quite thorough. They removed all company names, obviously.
Yeah.
But also, they replaced actual calendar years with generic labels, like year T, year T1.
Ah, okay.
And they standardized the financial statement format itself, so it wasn't unique to any specific company's reporting style. The goal was pure, abstract financial data. No clues about identity or time period.
Got it. And the paper has some charts comparing performance, figures 2 and 3. What did those show?
Right. Figure 2 is the head-to-head GPT versus human analysts. It uses accuracy and also F1 scores, which balance precision and recall, sort of a robust accuracy measure.
And the winner was?
GPT, with chain of thought prompting, came out clearly on top. Higher accuracy, higher F1 score compared to the simple GPT prompt, and notably better than the analyst forecasts over different time horizons they looked at.
Okay. And figure 3, that was against other machines.
Yes, figure 3 compares GPT-4 with COTI against various established machine learning models designed for financial forecasting, things like logistic regression, neural networks.
And how did it stack up?
Very competitively. Its accuracy and F1 scores were right in the mix, sometimes slightly better than these specialized models, which is impressive for a general model.
And figure 7 tried to get inside the why, right? Looking at the language GPT used.
Exactly. Figure 7 analyzes the words and phrases GPT generated in its COTI rationales. They looked at common word pairs, big rims related to ratio analysis, and common single words monograms in its overall explanations.
What did that reveal?
It showed GPT was focusing on things you'd expect a human analyst to focus on: profitability ratios, revenue trends, expense analysis, liquidity, solvency. It suggests the reasoning process, at least on the surface, mirrored human analytical approaches.
In Table 6, that was the memorization check again?
Yes. Table 6 details those tests where they asked GPT to guess the company or year from the anonymized data. The fact it performed poorly on that task reinforces the conclusion that its prediction success wasn't based on just remembering specific facts from its training data.
Okay, then Figures 8 and Table 8, the asset pricing tests. You mentioned the trading strategy simulation. Tell me more about that.
Right, this is where they test the economic significance.
Yeah.
They built that long-short portfolio. Buy stocks GPT predicted would beat earnings expectations. Sell stocks it predicted would miss.
Standard sort of quant strategy setup.
Pretty much. And they found this strategy generated substantial cumulative returns over their test period, significantly outperforming the market benchmark.
And the alphas. You mentioned alpha earlier.
Yes. Table 8 shows the alphas, the excess returns after accounting for known risk factors like market risk, company size, value versus growth, momentum, profitability. The GPT strategy generated statistically significant positive alphas against various standard factor models.
Which means, in theory, it was finding some predictive signal not captured by those common factors.
That's the interpretation, yes. It suggests the LLM's analysis provided unique, economically valuable information.
Now, Table 4, Panel B, it looked at where things go wrong. When did GPT and humans tend to make mistakes?
Yeah, that's interesting too. Both GPT and human analysts had more trouble predicting earnings for certain types of companies.
Like which ones?
Smaller companies, companies with higher financial leverage, companies currently reporting losses, and perhaps unsurprisingly, companies with more volatile or unpredictable earnings streams historically.
So, harder to predict companies are hard for everyone.
Generally, yes. Though the paper noted that company size seemed to affect GPT's accuracy a bit more strongly than human analysts, maybe because its training data might skew towards larger, more frequently discussed companies.
Makes sense. And Panel C of that table, incremental informativeness. What's that about?
Panel C basically asks, does GPT's prediction add anything new? Does it provide information beyond what we already get from traditional quantitative models or from human analyst forecasts?
And does it?
The analysis in Panel C suggests yes. It shows that GPT's predictions remain statistically significant in explaining future earnings changes, even when you control for the predictions from other ML models and analyst forecasts. So it seems to be capturing something unique.
Okay, so that first paper paints a, frankly, pretty powerful picture of LLMs potentially acting like or even exceeding human financial analysts in specific tasks.
For that specific task of predicting earnings direction from standardized statements, yes, the results are quite striking.
Right. But now let's shift gears to the second source, that BIS report on regulating AI in finance. The tone feels different, more cautious.
Definitely more cautious. The BIS report acknowledges the potential benefits, efficiency, productivity gains, all that.
Sure.
But its main focus is on the friction points. Is the way AI works actually compatible with existing financial regulations? Especially around big concepts like accountability, responsibility, transparency.
Why the friction?
It highlights this fundamental difference in how AI, especially machine learning, operates. It's inductive. It learns patterns from data. This changes how financial business gets done compared to older, more deductive or rule-based systems.
And that inductive nature leads to the black box problem everyone talks about.
Exactly. That's a central theme. The report really hammers on the difficulty of understanding why an AI made a particular decision. Think about credit scoring or insurance pricing or even automated investment advice.
If you get denied a loan, you want to know why.
Precisely. And if the lender can't clearly explain the AI's reasoning, that undermines fairness, accountability, and makes it hard for regulators to spot potential biases or systemic risks. It erodes trust.
Beyond the black box issue, what other big risks does the BIS report flag?
They highlight several. There's the risk of financial exclusion algorithms, maybe inadvertently discriminating against certain groups.
How could that happen?
Well, if the historical data used to train the AI reflects past biases, the AI might learn and perpetuate those biases, even if it's not explicitly programmed to. Denying loans or charging higher insurance premiums unfairly, for example.
Okay, what else?
There's the growing reliance on a small number of third-party AI providers that creates concentration risk. If one major provider has an issue, it could impact many financial institutions.
Like a single point of failure.
Or potentially, yeah. Also, the risk of herding behavior in markets if many institutions start using similar AI-driven trading strategies. And just the sheer challenge for supervisors to keep pace with the speed of AI deployment.
They mentioned the EU AI Act. How do they view that?
They see it as an important first step, particularly its risk-based approach classifying AI systems by potential harm.
But not sufficient on its own for finance.
They argue finance needs more specific attention. One key recommendation is for regulators like the European Commission to do a detailed gap analysis. Basically, look at existing financial rules and figure out where they fall short in addressing AI-specific risks to consumers and investors.
The report also makes a point about human versus AI intelligence deduction versus induction. Why is that distinction important in finance?
It's a really interesting point. AI, especially current ML, primarily learns inductively from past data. Humans can do that, but we also use deductive reasoning, logic, intuition, heuristics. We can sometimes draw conclusions even without direct prior examples.
So what's the implication?
The big one is that AI might struggle with true novelty, with unprecedented events, black swans. Because if something hasn't happened much or at all in the past data, the AI hasn't learned how to react to it. It's great at optimizing based on history, maybe less so at anticipating radical breaks from it.
What about specific challenges for the supervisors themselves, the regulators?
The report points to things like detecting sophisticated deepfakes used for fraud or market manipulation, preventing AI-driven disinformation campaigns, and also the increased cyber risk AI systems can be targets. But AI tools can also be used by attackers.
Fairness comes up again. What's the take on achieving fairness in AI for financial services?
The report acknowledges it's really complex. Defining fairness itself is hard, especially in areas like insurance, where risk pooling is fundamental. Whose interest do you prioritize? The company, the individual policyholder, the entire pool of insured people, society.
Tricky balancing act.
Very. And fairness perceptions change over time. The report suggests digital tech and AI offer opportunities, but also make achieving and demonstrating fairness more challenging.
And transparency explainability figure 2 in the report focuses on this.
Yes. Figure 2 really underscores that explainable AI, XAI, is foundational for trust and governance. But achieving genuine explainability, especially with the most complex models like foundation models or generative AI, is still a major hurdle.
They differentiate explainability and interpretability.
They do. Explainability might be about tracing the technical steps the AI took. Interpretability is more about understanding the why, in human understandable terms, the logic, the features it weighted. Interpretability is often the harder goal, especially for these really complex systems. They mention the NIST principles for XAI as a useful framework here.
And how does this play out in practice, like in credit or insurance decisions?
The report notes that the sheer complexity, the billions of parameters, the sometimes probabilistic nature of generative AI outputs it all makes, explaining why a specific person got a certain loan decision or insurance, quote, incredibly difficult compared to simpler, older models.
But interestingly, the report suggests AI might not be creating fundamentally new kinds of risk.
That's a key nuance. They argue AI tends to amplify or change the nature of existing risk categories. Model risk, data risk, bias, privacy, security, cyber risk, third-party risk. It's not necessarily introducing entirely novel risk types regulators haven't thought about before.
Just making the old risks bigger or harder to manage.
Or requiring different tools and approaches to manage them, yeah. The challenge is adapting existing risk management and supervisory frameworks to the scale, speed, and opacity that AI can introduce.
Which leads to the final point from that report, the need for skilled supervisors.
Absolutely crucial. Regulators and supervisors need to build up their own expertise. They need people who understand AI technology, its capabilities, its limitations, and how it's being deployed in finance.
That sounds like a challenge in itself.
It is. Finding and funding that expertise within supervisory bodies is a real issue, the report flags. How do you ensure regulators have the resources and skills to effectively oversee this rapidly evolving landscape?
Right. Okay, and we had that third brief source, sentiment trading with large language models. We didn't dive deep, but the title hints at another application.
Exactly. So far, we've talked LLMs analyzing fundamental company data and the regulatory view. This third piece points towards using LLMs to read the mood of the market.
How? From news and social media?
Presumably, yes. Analyzing news articles, maybe tweets, financial reports, looking for patterns in language that indicate positive or negative sentiment towards a stock, a sector, or the market overall.
And then trading based on that sentiment analysis.
That's the idea. It's another angle, using LLMs not just for the numbers, but for understanding the narrative and psychology driving markets. It shows the breadth of how these tools are being explored in finance.
Okay, so pulling it all together, after diving into these sources, what are the main takeaways for someone trying to grasp this?
I think there's this really interesting duality. On one side, you have the financial statement analysis paper showing, wow, these LLMs have some serious analytical chops, even with numbers. They can potentially uncover insights, maybe even outperform humans in specific structured tasks, possibly by deriving narrative meaning from quantitative data.
The promise, the power.
Right, but then on the other side, you have the BIS report sounding the alarm bells about the practicalities and risks, the black box issue, accountability, fairness, potential market instability, the sheer difficulty of effective regulation and supervision.
The perils, the challenges.
Exactly. So LLMs show huge promise for transforming parts of financial analysis and operations, but their integration brings significant challenges that need careful navigation by institutions and regulators alike.
It's that classic tech story. Amazing capability meets complex reality. So you, listening, should now have a much better handle on both sides of that coin.
Hopefully, yeah. The core tension is pretty clear.
Which leads us to maybe a final thought to leave you with. We see these LLMs advancing incredibly quickly. At the same time, we see these inherent difficulties in regulating black box tech effectively.
The pace mismatch is real.
So the question really becomes, how do we make sure this pursuit of AI-driven efficiency and maybe even analytical superiority in finance doesn't accidentally undermine market stability, fairness, or that fundamental bedrock of consumer trust?
That's the billion-dollar question, isn't it? Finding that balance between innovation and safety.
It seems like it demands constant dialogue, researchers figuring out what's possible, the industry implementing it, and regulators trying to keep the guardrails appropriate and effective, not a one-time fix.
Definitely an ongoing process.
Something for you to definitely think about as you watch this space unfold. Thanks for exploring this with us today.